Powell has a very, very difficult job in terms of not trying to be too dovish, because if he is too dovish, then all of a sudden that's going to send a different signal to the market where the Fed is very, very nervous, and I think that's the wrong thing. If he's not dovish enough, then that also creates a big problem too. So I think it's going to be extraordinarily difficult for Powell to actually satisfy the market and for us to get the reaction that we want, although it may happen, but it's a very narrow line.
I think on the equity markets, you've already priced in a recession on so many sectors. You know, if you look at the cyclicals, manufacturing, financials, we're already down to some of these are below book. We're looking at, you know, balance sheets that are really strong, cash flows that are strong, and also if you look at kind of what your dividends are getting now compared to your 10-year. So you're going back to this point where I think the Fed is in a position to say, okay, things are still good, but our inflation inputs are down. And you guys were talking about oil before. The story we had in 2016 when oil went below 50, you're going to get other issues now. You're going to get foreign countries selling stock in our country just to raise cash. That's going to put even more pressure on our equity markets. Now, I know his job is not equity markets, but it's also to say, let's have some stability in our economic system. And I think part of that should be we're looking at all the data, and going forward, we will be data dependent and not necessarily just raise rates, because guess what? The rest of the world also is not in a position to raise rates like we are.
I thought what FedEx said yesterday was really kind of concerning. As you hear what happens, they'd be the first ones to see it. And they're seeing what's happening around the globe.
And I think exactly to the point where we knew the tariff overhang would cause some of this slowdown, and you're seeing it now. You're seeing it in the numbers. So
real weakness in Europe too. We're not just talking China weakness.
You know, there's something else. The structure of our market: ETFs, index funds, quantitative approaches. Stan was interviewed by Bloomberg. And he said one of the reasons he gave up was because it's a new game.
Yeah, because
so there's a disconnect between what used to be the yardstick by which you measured stocks, earnings, and dividends, and so forth. It's a casino now.
Yeah.
And the only hope you have is to own great companies, put them away, and don't look at the market.
I completely agree with you. I think some of the data points that we used to see in the past are now just muddled because there's so much coming at you.
Exactly.
So when you
look at Caterpillar. Caterpillar's having an excellent recovery.
Yep.
Guy running it's doing a great job. Balance sheet's better, cash flow. Go look at all, and you say, hey, wait a minute, why?
Yeah. And you see that, to your point on manufacturing. Look at Honeywell. Look at some of the others.
I was just talking to Darius yesterday. By the way, he's doing a hell of a job with that company and what he's done to restructure it. And Cody before him, and Larry before him. There's some great values out there. And the thing you can't do, you don't have the luxury of being emotional about the market anymore, because there are so many things that defy logic, that if you go with the whims or you go with the wind, you're going to get whipsawed at best, and at worst, you're going to miss a great opportunity.
And I think the one thing that we hear a lot from investors is saying, well, this recession's coming because it has to come,
Let
right?
it come.
Well, it's kind of saying, well, I get sick once a year, so I have to get sick now. Well, you know what? You cannot get sick once a year. You can get sick once in 3 years. But I think if the fundamentals are so strong and we don't get into this self-inflicting wound that it seems to be happening now because everybody wants it to happen, I think, if that doesn't happen and we get some positive from the Fed, this market could rebound and do well in the long term.
And I think that's a key point, right? So we're all priced for the worst in many ways, maybe not the absolute worst, but we're certainly priced for a significant slowdown. So what are we talking about here? We're talking about potentially the Fed downgrading their growth expectations from 2.5% to 2.3%. We're growing at 3% this year. You're still growing above potential growth, right? So this isn't a collapsing GDP market. Inflation is not unanchored. The Fed can actually go a lot slower. So if we think about the neutral range for the Fed, what they've told us, it's about 2.5% Fed funds to 3.5%. They go today, they're at the lower end of their range. They can claim victory. They can claim that they've normalized. But then they say the bar is really high for us to continue to go further from here. That could be a communication. The other is on the balance sheet, which is something else that's out there too, which is that's another lever that they can pull. Are they on an automatic preset course to reduce their balance sheet $50 billion per month, let's say, for the rest of 2019 and into 2020, or can they actually take a little bit of a breather? I think they have some levers to pull.
So there's a perception, you guys, that staying at zero for so long caused a debt explosion globally.
That was Druckenmiller's and
Marsh's Okay, position. So now if you go up a little, the amount of debt service grows exponentially as you go up a little. If we go slow, and we space it out further,
right.
Can we digest what the evil or the bad things that were done? Can we over time digest all this?
Right.
Or are we screwed no matter what?
No. You know, there is a path, and you're absolutely correct. There is a high level of debt that's out
everywhere.
there.
Corporate.
Everywhere. Sure, of course.
Government,
now,
household.
So leverage is going to be calculated as your debt divided by your earnings, effectively. So if you hike slow enough and you keep earnings at least robust enough, then you can delever yourself with some growth. The problem is if you have a sudden shock and growth slows too fast too quickly, and that could be triggered by a Fed policy mistake where maybe they hike too much too fast, then your leverage ratios go up, and then that level of debt becomes a much bigger problem. But as long as we get decent earnings for a period of time, then yes, you can delever, in a much more orderly fashion.